My name's Adam, and again, thank you for joining us this morning and taking time out of your day. I'm an account executive with WHEDA. I am the Central and Northern Region representative, and I take care of everybody that operates and does business within those region or within that region. But really, I wanted to talk to you today. Tom brought me on to talk about WHEDA, how we're different, how we changed, and how our programs work. So we'll go ahead and jump into everything here. First, I kind of have to go over a legal disclaimer. As with anything in our industry, things can change. We always recommend that you go back to our website, WHEDA.com. It's going to have the most up-to-date information. But of course, I'm not going to go over any out-of-date information today, but just in case anything changes. And today I'm going to talk about a lot in a very short period of time. So we're really going to talk a lot of the things on here, and we'll jump into things that in a little more detail, but we're going to go over some common misconceptions because I want to get those out of the way first. What WHEDA is and who we are, the benefits and just some general information, our programs, our down payment assistance, how we work with our lenders, and then how WHEDA pre-approvals impact your offer, and then lastly, any resources that are available to you and your buyers. But first, we'll go through some of the common misconceptions and how to identify who is a WHEDA borrower. So sometimes buyers or borrowers are in touch with you first, and not necessarily with the lender. And there are some key things that you may hear that should trigger, I should get them in touch with a WHEDA lender. Things like hearing, I need down payment assistance is a huge red flag of, hey, I need to get them in touch with a WHEDA or a WHEDA lender because WHEDA has down payment assistance. Or my credit score is good, it's not great. So that's going to impact the rate, as we know. But with WHEDA, we don't have any pricing adjustments. So the rate is the rate, no matter the credit score. That would be another trigger that I should get them in touch with a WHEDA lender. Hearing that they're low or moderate income. So when you're talking about that, or you kind of know by the pricing point, those should be key triggers to get them in touch with a WHEDA lender. And then just some common misconceptions out there. Before I jump into these, and feel free to unmute yourself. I want to hear from you. What are some of the things that you hear, good, bad, about WHEDA, especially the bad, I want to know, or things that you've heard, things that you know, but please, absolutely unmute yourself. What are some of those things that you've heard?
Or who has used a VA loan recently? You want to comment?
My husband and I did.
Used a VA loan?
The VA loan, yes.
So we'll talk about how WHEDA is one of the competitors to VA, and how actually purchasing with WHEDA and how you can still retain your VA mortgaged home and take advantage of a WHEDA loan on your next purchase. But some of the common misconceptions is that we only work with first-time home buyers. That's not true at all. In fact, 50% of the business, I would say, or roughly 50% of the business that comes through the door for WHEDA is actually with non-first-time home buyers. We do business with all borrowers as long as they're purchasing in Wisconsin and are below our income limit requirement. Next is that you have to have down payment assistance if you use WHEDA. Wrong. You don't have to have down payment assistance. We do mortgages with borrowers that put 20% down or 50% down. They have a large gift, whatever it may be. They don't have to utilize down payment assistance in order to utilize WHEDA. The next one is a big one that we require additional inspections. We don't. We're going to follow what's in the offer. So in your offer, if you're putting a well and septic inspection, well, yeah, we're going to, because it's in the offer, we have to follow a contract. We're going to want to see it. Outside of that, we're not requiring any additional inspections. And in fact, if buyers call us, we encourage them to get home inspections because we know it's for their benefit. Appraisals. A lot of information out there, or that some people have heard, is that we're a government loan. Well, we're not. We're not a government loan. Do we do government loans? Yes, we do FHA loans. But in fact, we also do conventional loans. We are a Fannie Mae and HUD seller servicer. So our appraisals are going to follow the program that the lender has approved for the borrower. So if it's a conventional loan, you'll have a conventional appraisal. If it's an FHA loan with WHEDA, you'll have an FHA appraisal or HUD appraisal. Next is that we have asset limits. We don't have any asset limits currently. So in fact, your borrowers could have $1 million in the bank, pay for the house in cash. But if they wanted to take a loan, they could, as long as they are below that income limit. Next is that we're going to run out of funds. Well, that won't happen because we're self-funded. And what that means is that by servicing all of our loans, because we service the loans until they're paid off, it's a revolving fund that comes in the door so that we can continue lending. So in addition, since we're self-funded, that means unless the governor signs a bill like he did with, I think it was Act 19 or Act 17, whatever it was, that signed over funds to the housing authority. Otherwise, we're not really, we're a quasi state agency. We're not connected to the state at all because we are self-funded. So that means my salary is self-funded. That means my benefits are all self-funded. It all comes through WHEDA versus the taxpayer dollars. And then lastly is that it takes longer or it's tougher to do a WHEDA loan. Well, as long as you understand a Fannie Mae loan and an FHA loan, we're really not any different. In fact, underwriting for down payment assistance loans and your first mortgage loan all happens at the same time. So it's not any additional underwriting. There's not any additional appraisals. It's really, if you understand Fannie Mae and you understand FHA, then you can understand that. So who we are a quasi-government organization. We were established over 50 years ago, and it was intended to increase the accessibility to affordable housing. So that means we have multiple departments, which includes single family, which is where I come from. And then we have multifamily and commercial, and then as well as the community and economic development. So our multifamily and commercial actually does partnership loans for agriculture, farmers. We work a lot with developers. Our community and economic development department works a lot with nonprofits. They work a lot with municipalities. Like if you hear of the downtown renovation stuff, a lot of times we are involved. Or if there is a housing development going in, that's affordable housing units, most of the time WHEDA is involved. So we do a lot of different things besides just single family lending. And really our mission is to give everyone access to, most importantly, safe and then affordable housing within Wisconsin. So as single family, and that's the department I come from, we offer affordable financing options with features and benefits that really give the borrower an edge towards making that loan affordable. Because if it's affordable, they're more likely to stay in the house longer. We offer, you've heard me say, conventional and FHA financing in addition to 2 additional down payment assistance options. We even have other loan options that are available. Keep in mind that each lender that we work with, we give the option to choose what products they want to offer. So not every WHEDA lender is going to offer the same products. So we have renovation products out there that some lenders choose to offer. But really, the most important thing to WHEDA is that we fulfill our mission. And we fulfill our mission by not only offering these products, but in order to do that, we also have to follow income limits. So we do have income limits for all of our programs, and they range from 80% to 140% of the area median income. They do vary by program, they vary by your household size and the county. And the huge benefit is that WHEDA is going to service a loan for the life of the loan right in Madison, where we're headquartered. And so that means when your buyer is calling WHEDA, they're going to talk to somebody in Madison. Actually, the lady that answers the phone, her name's Sarah, and she answers the phone and she'll transfer the borrower to, the department that they need. So innately, we always kind of want to know what are the benefits to doing something, even though we may not express it, we want to know what some of the benefits might be. So for the benefits for your buyers, the biggest benefit is that we offer 3 ways to get a reduced rate. So most commonly used or thought of as the first-time home buyer, and they get a reduced rate, which I didn't look at the rates today. Tom, did you happen to look at the rates today?
Sorry, I was on mute. Yeah, right now the first-time homebuyer Valor program as well are both at 6.375.
Yeah, and the standard rate today, say on a 30-year Fannie fixed.
That one, I believe, is the upper 7 or right around 8%.
Yeah, upper 7's close to 8. So you can see that the reduced rate is significantly lower, over a 1% difference to your buyers, which we all know when COVID happened, or not COVID, post-COVID, when the rates started going up, I saw a lot of emails going out, as the rate goes up a whole percent, that lowers the buying power of your buyers by almost 30,000. So if we can lower that interest rate, we're increasing your buyers' buying capability or buying power by that difference. Now, first-time home buyers have to meet the IRS definition. That's what we follow. It's a bond regulation. So they can't have had ownership or benefit of ownership in a property in the last 3 years. The next way borrowers can receive a reduced rate is through our Valor program, like Tom mentioned. And that's if they're an eligible veteran with a DD 214 with honorable discharge. This is a huge benefit because this is not a VA loan. So being that it's not a VA loan, we're not tapping into VA benefits. There's no eligibility requirement besides having honorable discharge in the discharge papers. There's no inspections, termite inspections. There's no VA appraisal. There's no funding fee. Also, because of how the Valor program works, you can take the additional down payment assistance for the 100% financing and still have a conventional appraisal. Now, the Valor program also, it can work for veterans that haven't served enough time in the military to qualify for additional VA benefits. So even if they're discharged, only served 6 months, they're medically discharged, but still honorable, perfectly fine. As long as that paperwork is honorable and it's on a DD 214, we're good to go. Borrowers purchasing in a designated target area is the third way they can receive a reduced rate. So there are federal and state designated target areas throughout the state of Wisconsin. And in fact, there are 15 whole counties. And unfortunately, a lot of those counties happen to lie in central and northern Wisconsin. But then there are municipalities throughout the state that are within a target area. So we're seeing Milwaukee, Waukesha, then there's Green Bay and Marathon. I mean, they're all over throughout the state. So if they're in a target area, Janesville is another one. If they're in a target area, they can receive a reduced rate. And in fact, if they're in a target area, they get the max benefit of the income limit. So it goes up to 140% of the area median income. So not only can borrowers utilize our down payment assistance, we also allow borrowers to take advantage of other down payment assistance. So if they're getting a grant, maybe they're getting a DPP loan or down payment plus. I believe Tom offers that as well. They could get, the DPP is forgivable over a period of time. They could take advantage of our capital access and bring $17,500 potentially to the table and not have a payment on that at all. So it's a huge benefit that we allow them to work with other down payment assistance organizations, municipalities that offer down payment assistance, or grants out there. We also offer the mortgage credit certificate. So this is a huge tax benefit to our buyers. They can take advantage of a $2,000 tax benefit where it converts the mortgage interest for 30 years. So they get it for the life of the loan, up to $2,000 every year. So they'll either lower their tax liability or increase their tax return, depending on their tax situation. And then, again, a huge benefit is that they can work with almost a local lender anywhere in Wisconsin because we have over 160 approved lending partners. Now, I mentioned before, we don't charge any loan level pricing adjustments, or you may have heard them as LLPAs. Now, what this means is that if Tom and I are both, going to different lenders, getting a WHEDA loan, my credit score is 680, and Tom's credit score is 800. Typically, Tom would get a better interest rate because his score is really, really good. But with WHEDA, we don't penalize borrowers based on their credit score. So we don't charge those loan level pricing adjustments. The rate is the rate. Everyone gets the rate no matter their credit score. And then we also offer the reduced cost mortgage insurance. So again, playing into that affordability factor, this can reduce the mortgage insurance. Like I pay mortgage insurance on my mortgage, and it's $212 a month. With an affordability or affordable mortgage insurance, if I would have qualified, it would probably have been half of that. So you can see it really plays into an affordability factor. Now, just some general information when getting a WHEDA loan that you need to know, or if you're talking to buyers about WHEDA, the homes have to be located in Wisconsin. Pretty straightforward there. And they have to be owner occupied. So we can't do investment loans or loans on investment properties or second homes. And they must meet the total household income limit. So that's really going to be, the goal is to get them in touch with a WHEDA lender like Tom, and then Tom will determine if they're below the household income limit. They also have to reside in the property. So what that means is that we don't allow any co-borrowers, essentially. Excuse me. So anybody that's on the loan has to be residing in the property. So mom and dad can't co-sign on the loan if they're not going to live there. And then when you're drafting documentation, so especially the offer to purchase, excuse me, a little bit of a tickle. When you're drafting that offer to purchase, the only people that can appear on that contract are the approved borrower or borrowers, and if there's a non-occupant, or excuse me, a non-borrowing spouse. So sometimes we see loans come through where it's just one individual, but then the non-borrowing spouse is also there. They can appear on the offer as well. We do require pre-purchase homebuyer education, especially if they're a first-time homebuyer, but also if they're purchasing a multi-unit property, because you'll find out how many units borrowers can actually purchase. We do require them to have landlord education. They have to have a valid SOCH and proof of legal residency. So we do allow for visa financing. So DACA status is a common one. And we talk about household members. So when Tom is talking to the borrowers, or maybe you're talking to the buyers, anybody that is a household member, anybody that lives in the property as their primary residence will be considered a household member. So when we're determining if they're under that income limit, we have to look at all the household members. So that could be different in every scenario. It could be a couple that has one of their parents moving in with them. It could be, an individual that has a roommate moving in. We still have to consider anybody that's going to be living there as their primary residence as a household member. Now, our WHEDA programs are pretty straightforward. Conventional, FHA, with some specifics that are specific to WHEDA. So with the conventional product, we allow credit scores to go as low as 620. Now that's for what we call manual underwriting, because I'll tell you the likelihood of getting an approved eligible through Fannie's automated underwriting system at 620 is never. You have a better chance of winning the Powerball. More likely you're seeing an approved eligible at 700, maybe a 680, depending on the loan scenario. But essentially 620 can still get a loan with WHEDA if they qualify for manual underwriting. Now, debt to income ratios are going to be determined by Fannie Mae's automated underwriting service. So I've seen loans as high as 49, even 50%, depending on the loan scenario and credit score. So as long as there's an approved eligible, you're good to go. We can only do 30-year mortgages with both products. So FHA and WHEDA, FHA and conventional are both 30-year. We don't have any other terms. And then in the conventional space, we do purchases and WHEDA to WHEDA refinances. But we allow borrowers, super cool, is we allow borrowers to not only purchase single family homes, condos, manufactured homes, but we allow them to purchase 2 to 4 unit properties, so up to quadplexes, as long as they're 5 years or older. So if your buyers are interested in being landlords and want to buy a multi-unit property, as long as they intend to occupy 1 unit, they can rent out those other 3. That's perfectly fine with us. And the down payment requirement for a multi-unit property is they have to have 3% of their own funds into the transaction. They can still take advantage of down payment assistance, but essentially 3% of their own funds, 2% of the down payment assistance equals 5% for a down payment, versus a multi-unit typically, Tom, is at 15 or 25. I don't remember. I haven't originated in a long time.
What was that?
I haven't originated in a long time, but if you have a borrower that, versus WHEDA's 4-unit, 3 or 2 unit,
Yeah.
typically a down payment is it 15 to 25 for a multi-unit? Is that how that
Yeah,
works?
so FHA 3.5. Conventional, they say potentially as low as 3%, but similar thought process on that is with a lower credit score for WHEDA, you're not going to get approved. So really, in all reality, you need 15% down for owner-occupied duplex conventional, because the likelihood of getting approved for anything less, even though it's quote unquote available, is very hard to get approved.
Yeah, so with WHEDA, they can go 3% of their own funds, 2% from down payment assistance to 5%, but 3% of their own funds, and then they can get that multi-unit property.
And Adam, with that being said,
Yep.
to go the 5% down on a conventional owner-occupied duplex, you have to get AUS approval?
On ours, it's manual underwriting as well.
Okay.
So we don't require an AUS approval. It could be a refer with caution. We could do a manual underwrite on a multi-unit. So for FHA, we have some caveats that are different because we're a little more conservative when it comes to FHA, only because we have a waiver with HUD. So that means that we're allowed to put our down payment assistance products behind a government-backed loan. So we require a minimum credit score of 640 for FHA and a max DTI of 45%. Now, I used to be an originator. This is my 15th or 16th year in the mortgage industry. And I mean, I used to do FHA loans at 600 or 580 and DTIs at like 53%. We don't allow that at WHEDA. We have our requirements. These are our overlays because we want to maintain that waiver with HUD to still offer FHA financing with 100% financing by combining it with our down payment assistance product. And we only can do purchases through FHA product. So that's a little bit different. We don't allow FHA refinances. We're still going to follow, FHA's 3.5% down, but it's 0 down because they can take advantage of our down payment assistance products, which going into our down payment products, we have 2 of them. The most commonly used is actually our Easy Close. So the Easy Close is 6% of the purchase price. So easy math in the morning here, because I haven't had a full cup of coffee yet. $100,000 purchase price. would get them a $6,000 easy close down payment assistance loan. So with that being said, 3,000 of the 6,000 goes towards the down payment, and then the other 3,000 is reserved for closing costs and prepaid items. So obviously, as the purchase price increases, the easy close amount increases as well. Now, this is a loan, it's paid back over 10 years. But just to give you an idea of what the interest rate and payment would look like, interest rate's going to be the same as the first mortgage. So that means if they're getting the discounted interest rate on the first mortgage, they're going to get the discounted interest rate on the DPA. And a payment wise, like if you have 11,000, I think the example I did was 11,400 for 10 years at 6 point, I think it was 6.5% when I did it, is roughly $126 a month. So the payment on down payment assistance with WHEDA isn't that much. It's sometimes less than a high interest credit card. Plus, it allows the borrowers to retain funds in their savings account. As an originator, I was offering down payment assistance, even if my borrowers had, 10,000 plus in their accounts. Reason being is because you've heard the stories, I'm sure, as realtors. I know I had heard stories as lender. Tom's probably heard them as well, is that something goes wrong in the first year of owning that home. If they don't have a home warranty or it's not covered by a home warranty, how are they going to pay for it if I, as the lender, just took everything they had for down payment and closing costs? So instead, offering them a low interest down payment assistance loan allowed them to keep the funds in their account in the event that something happened. And since there's no prepayment penalties, they could pay it off anytime they wanted. So a lot of times my borrowers that had the funds set aside, they'd pay it off in 2 years because they're like, you know what, we don't need this anymore. We're doing great. We've saved up more money. Perfect. They pay it off. No problem. There's no penalty for doing that early. The other product we have is Capital Access. Now, this is our zero interest accrual, zero payment loan. It's still a loan. It's not a grant. That gives borrowers $7,500 flat to put towards down payment and closing costs. So this is combined typically with DPP or Down Payment Plus or other grants or down payment assistance products outside of WHEDA. So because there's no monthly payment, it really plays into that affordability factor and is very, it's not used as frequently, but it's very enticing to use and try to qualify your borrower for because of that no payment. But again, pairs with other down payment assistance products very well. In fact, like I stated before, the DPP or Down Payment Plus, they can get a total of up to $17,500 between the two products to put towards down payment and closing costs and not have any payment on their down payment assistance. Now, this loan, it still gets recorded and secured by a mortgage and a note, but it's not paid off until they sell or pay off their first mortgage, whatever comes first. Now, how we work with lenders throughout the state of Wisconsin, because we have to follow state statutes, WHEDA can't directly lend to the consumer. It's against the law for us. So we're not allowed to reach out to borrowers and try to give them a loan. We have to work through a network of lending partners, including banks, credit unions, and mortgage companies alike. And anyone that qualifies to be a lending partner, first off, has to have a brick and mortar in the state of Wisconsin. We want to know they have some sort of economic impact within the state. Once they're approved, they're able to offer our products to our potential, borrowers or buyers. So once they close the loan, so like in Tom's instance, he's got a WHEDA buyer, closes the loan, they're going to sell the loan to us. We'll review it for purchase. And at that time is when the buyers will start working with WHEDA directly when they start making their payments. So we, like I stated before, we have over 160 financial institutions in the state of Wisconsin that buyers can choose to work through. So literally anywhere. And most of them, like Tom, are licensed to do business anywhere in the state. So we offer our lending partners the ability to do business 3 different ways with us, and that we call the delivery channels. So we have a broker relationship, a mini correspondent relationship, and a wholesale relationship. So what this means to you as realtors is really it impacts underwriting times. So if they're a broker or a mini correspondent lender with us, WHEDA is underwriting the loan. So the underwriting times are going to be up to WHEDA. Right now, WHEDA, because of sheer volume, we're at 3 to 5 days for underwriting. Correspondent or wholesale lenders, it's up to their underwriting department on how long that takes for underwriting. So I'm pretty sure Tom is faster than WHEDA right now. And that's really because of sheer volume. And in fact, we're hiring additional underwriters. So until they get trained and onboarded, that time will come down. But just keep that in mind when it comes to when you're talking about underwriting times, is it does depend on how they do business with us. I think, like I stated before, we allow lending partners to pick and choose the products they want to offer. So I know Tom, they don't offer the renovation product, but I know other lenders do. So we allow lenders to choose what best fits their, scenario or their goals as an institution. Now, how WHEDA pre-approvals impact your offer it's really kind of cool. Sometimes you're going to get a pre-approval that you're not even going to know that it states WHEDA because it won't say WHEDA. It may just say FHA or it may just say conventional. Sometimes you'll get an offer or a pre-approval that states WHEDA. So it's important that you check with your broker because they may have different requirements, but WHEDA requires or doesn't require in this matter. We don't require you to put WHEDA conventional financing in the financing contingency or WHEDA FHA financing in the financing contingency. It just literally has to say conventional or FHA. We also don't require any sort of down payment assistance addendum. So I know sometimes I've seen addendums that are done because borrowers are receiving down payment assistance. We don't require that from WHEDA standpoint, but again, you're going to want to double check with your broker. The other thing too is a lot of times we see a financing contingency with 100%. In fact, you should be following the loan to value on the pre-approval, which should be 97 typically, because they're doing a 3% down. Now, I get a lot of questions of, well, what about the DPA? Well, the DPA, in fact, is just the icing on the cake. I mean, it's really, we're offering assistance. The main loan to obtain the home is what belongs in the contingency from WHEDA's standpoint. Now, when it comes to the appraisal requirements, you're going to follow what you put for conventional. If it's conventional, if it's FHA, you'll follow what you put for FHA. So keep that in mind when you're filling out your offers or if you're presenting an offer. And when it comes to underwriting those down payment assistance loans, like I stated before, they're underwritten at the same time. So you don't have to work in any additional time into any of your timing contingencies. Now, keep in mind, if your borrowers are receiving any down payment financing or down payment assistance through a municipality or a nonprofit or another organization like NeighborWorks, they may have their own program guidelines that may require mention in the offer. So you may want to reach out to them as well to make sure they don't require something for the offer. But from WHEDA's standpoint, as long as you're putting conventional or FHA financing in the offer, following the down payment, we don't require any down payment addendum. You're perfectly fine. So when you're presenting the offer to the seller and it says conventional, even though it's WHEDA, essentially WHEDA is just chosen as the final servicer in this case. So Tom, when he's doing a conventional WHEDA loan, he's basically telling the borrowers, hey, you're getting a conventional loan and we're choosing WHEDA as your servicer. So it's no different than getting a conventional loan anywhere else. So when you're presenting the offer, it's just like presenting any other offer with conventional financing. Now, there are resources available to you. There are resources available to consumers. So we actually have out there, it's completely open to the public, our lender toolkit. This is going to have a ton of information both for you, just to have at your office or in your back pocket when you're talking to buyers. I put a link there when you receive this I'll send it to Tom so he can forward it out. Or if he forwards me your emails, I will definitely send out a copy of the deck page or deck slide here. But these links will be live, so we'll have our income limits there if you ever want to review the income limits for the counties that you operate out of. But then we also have the consumer page resource there for your buyers. It's going to talk about budgeting, what to expect in the process, and then links to our live webinar for first-time home buyers. Now, I know I reviewed a ton of information. I hope I have some questions that come in, whether it's stuff that you're working on currently with WHEDA or just general questions about what I covered. Just let me know. What questions do you have? Feel free to unmute yourself.
So I new to
Go
this
ahead,
industry.
Brittany.
Oh, sorry. So I'm like new to this industry. I'm like brand new. So whenever it comes to like these specific loans and everything, you had hit on credit scores and whatnot. What would a red flag be for like the lowest credit score? Like somebody probably won't be able to buy. Like what are things that I should be looking out for that are like kind of red flags?
So that would be a good Tom question instead of
Okay.
WHEDA specific. Yep. So Tom, do you want to answer that one and tackle that?
Yeah, so although WHEDA has a lower score requirement for conventional, as Adam mentioned earlier, the likelihood of getting a WHEDA conventional approval under 680, unless the client's super strong, which those people aren't from an asset perspective of reserves and a few other factors, it's probably not going to work unless they're above 680 because people that use the program don't have a tremendous amount of extra reserves or low DTI. So I'd say 680 or higher for conventional, and then WHEDA 640. But with the conventional part, we also have a non-WHEDA program if they're a first-time home buyer and they're at or below certain income thresholds, 100% or 80%, we can give them a better rate than the going rate. So for example, if they had a 660 credit score, just like Adam said, they get the going rate for WHEDA first time homebuyer program, whether you're 680, 660, or 780 and above. Same thing with one of our conventional programs for first time homebuyers. So if we can't go WHEDA, there might be another opportunity to go through a different conventional program if they have a lower score and still get a good rate, just not quite as good as WHEDA's.
Okay, perfect. And then just because it's an election year and everything, and just back to I'm brand new to this. So how do we think the interest rates are gonna look this year as opposed to possibly next year? Do you guys have like a kind of an idea of that?
I don't. I have a better chance of winning the lottery than telling you what I think rates are going to do. And my focus isn't really rate focused because I'm not an originating loan officer. My focus is really education and lender relationship management. Tom probably has a better idea of, getting emails from internal sources at his institution about what they think rates are going to do.
Yeah, we originally thought the Fed were going to cut anywhere from 3 to 6 rate cuts this year, and as you can see, we haven't had any yet. So we anticipated rates to be down already by now, but inflation's being stubborn. Unemployment number isn't coming or isn't increasing like they're anticipating. So I think there's a couple forces until those break. Like example, Fed wants the inflation at 2%. And they want us, if we start seeing an unemployment number creep up to 4.1 or higher, 4.1% that is, then we'll start seeing some rate cuts. We're anticipating potentially one rate cut yet this year. I know the European Central Bank just did one today at 25 basis points. So that's good news. I believe we'll probably see better rates next year than this year. This year we could see a little bit better, but it's going to be a little bit choppier just because of everything going on. I guess you could say election, but the economic reports are kind of one day you might get a good one, and then 2 days later a bad one. So it's going to be rather choppy, but I think we'll see better rates to come in 2025.
Okay, perfect. Thank you. Sorry.
All good. Tina, did you have a question before?
I love the idea that you are putting down that WHEDA is conventional. Does it say conventional WHEDA loan, or is there, like, when we're writing an offer, is there WHEDA at all written on that?
We don't require WHEDA to be written on the financing contingency. And in fact, most of our WHEDA lending partners, so like Tom, I believe his pre-approvals are just going to say conventional. And you may not even know they're getting a WHEDA loan until the very end, or unless your buyer says that they're getting a WHEDA loan.
Oh, so as the, excuse me, as the agent, you won't even know that it's a WHEDA from the lender unless we're specifically asking?
Yeah, unless you're asking, or they mention it like, yeah, they're getting a WHEDA loan, or because you're going to get a pre-approval. Most of the time, they're not even going to mention on the pre-approval that it says WHEDA conventional loan.
Well, that's awesome. Thank you.
Yeah. So, and even if it does say WHEDA conventional loan, again, in the contingency, we only require from WHEDA standpoint that it's a conventional.
Thank you.
Yeah, because basically it does follow Fannie Mae guidelines. So it's a Fannie Mae loan. But as Adam mentioned earlier, the only difference is WHEDA is going to service this loan. That's why it's a WHEDA loan. Otherwise, it's a standard conventional loan. So, me personally, I don't think it needs to be on there because it's a conventional or a VA, or, well, there's no VA, it would be a conventional, but, or FHA. So all the clients I've been working with over the last several months, it was either conventional or FHA.
Yeah, and the other thing I want to mention about the down payment assistance I forgot to mention is that because they can get up to 6% of the purchase price, I see a lot of our buyers not having to ask for, and I've seen an increase, especially up north here, maybe not necessarily down in your region. We've started to see an increase up here of buyers asking for seller concessions. And with WHEDA offering 6% of the purchase price, buyers aren't having to ask for seller concessions if they're a WHEDA borrower. So sometimes those not asking for seller concessions are going to beat out other offers when it's still really a competitive market.
And yeah, just to give a couple things here. We've closed a few of them recently. We closed a WHEDA conventional with DPP funds, down payment plus funds. So we have a $10,000 grant, depending upon the county the client's buying in, the family size, and their income. We can potentially get them $10,000 that's fully forgiven over a 5-year period of time. So we're able to help one client with that. And then we also had another client in the past month where we did FHA WHEDA with the easy close second.
Yeah, so the FHA with the easy close second covers their 3.5% down payment for FHA and gives them 2.5% towards their closing costs and prepaid items. A lot of times we're seeing our the buyers actually getting cash back at closing, like their earnest money or prepaid appraisal, or maybe they paid for an inspection or their insurance up front. They're getting some of that money back because there's excess funds from that down payment assistance that can help cover those costs for them.
And we are currently working on a Valor loan with the easy close second.
Awesome. Any other questions out there? So I know Tom was going to put a link in the chat for some feedback. I myself, when I send out the deck slide, I'm going to have a link for feedback for me as well. We really appreciate your feedback because I am really pushing for a realtor landing page with WHEDA so that we can start showcasing realtors as well as lenders. And I'm trying to gather feedback, and data is everything. So if I can gather as much data and feedback as possible, I can take that to our director and say, hey, this is what the people want. So I really encourage you to take 5 minutes out of your day. I know it's super busy for you, but to take both of our surveys and give us some feedback. It would be really appreciated.
Thanks, Adam.
Yeah. Otherwise, I don't have anything else for all of you. Tom, if you don't have anything else, you can let them get back to your day.